Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Greetings, everyone. Samantha LaDuc, founder of LaDucTrading.com, joined by Hans Albrecht. We are coming together to do macro to micro options power hour. We're here to talk about Powell coming in today and basically not playing ball with Trump. He was very much hawkish. That doesn't mean the market can't sell off aggressively and Powell comes in later for a little capitulation. But right now, the upside bet is we really need Trump to either say, I'm just kidding, or for Powell to capitulate. And chances right now are kind of hard to do that. So let's just take a look at what we've got for the market today. Lots of selling, but a little reprieve at the end of the day. SPX 5250 held, which is hysterical. Hans, get us a little bit update on what you see on market structure.
Yeah, so, well, first I see a nice comment in there. I want to thank both of you for your insights. I started hedging, it protected me. So that's terrific. Somebody saying wonderful how much value you guys are delivering every week to your followers. So that's really, really nice.
Good to hear. Good to hear.
Yeah. So, I mean, look, we've been talking about this sort of, it continues to be a long volatile type environment, one in which you have to sort of be very, very careful. I think I think we retraced about half that full sell-off, more or less. And that puts the market in kind of very lofty valuation levels if we continue along this path, which is putting growth in jeopardy and putting the analysts in a very difficult position of trying to figure out where things are supposed to be. And so I think we're going to get these lulls. This is very much part of a VIX 25 plus market, let alone 30, 35, 40 plus, where you're going to get these big moves to the upside. And I remember 2022 very, very well. We had incredibly strong bear market rallies. They made you think that everything was okay again. And here we are. The interesting thing about it is we really are seeing sort of some of the things that I'm looking at are kind of pointing to many entities having deleveraged already. So I'm looking at these vol targeting. They're down around 1 or 2 percentile in terms of their long allocation, CTA, these kinds of funds that have sort of really unloaded a lot of their long positions. And we're seeing skew extremely pricey. I'll show you guys in a moment, but just incredible skew, downside skew, put skew, and upside call skew, very, very suppressed. So we really are, and even when we were sort of trading, say, 150 points higher, we were sitting in this position where structurally it really looked like the sort of cheaper, edge play was to the upside. But I think it was just a little bit too much for the market to bear at these sort of levels where, we were talking about it last week where I thought, this is a bit of a gift. I mean, you've been spot on lately. So, and I said that, yeah, this is a gift for people who didn't have a chance to hedge, who didn't have a chance to lighten up in some of these names. And I've been talking about this idea that we're going to get a big reflexive bounce in a similar way that we had the sell-off. So sell-offs, and I've seen too many of these over 30 years, sell-offs, those initial ugly sell-offs tend to be liquidity type events where everyone gets sold off. They sell good, they sell bad. There are a few tiny little pockets where people move into, but they sell pretty much everything. And the bounce back, I said, would probably be similar, very high correlation. Everything kind of bounces back before we entered into this sort of new part of this market, which I believe is starting to be a little bit more selective. So, and I said, I'm not interested in getting into the Nvidias, the MAG. I think it is broken. Their charts are broken. Their stories are broken. This is where you want to start to look for different things, maybe a little bit away from bits and bytes and zeros and ones and digital and into sort of the real world. And I think we're seeing a little bit of that move. Again, the last few days, over 5 or 6 days, we've seen staples do well again, utilities, even some little bit in financials, they got trounced a little bit, but discretionary, tech struggling, a very difficult market in those areas that people have really come to believe in over the last couple of years. So I think it's a very confusing market where they really do need a little bit of guidance. So that's sort of what I've been thinking. We're seeing that bifurcation happening where now the market can say, okay, we've bounced back from the end of the world. We got our bond put. We got our little bit of good news from, hey, we're going to spare semiconductors and phones, which may or may not be happening. Now we get to sort of sift through the rubble and take a look at where we really want to be if this year progresses in a way that we haven't seen in a very, very long time.
Indeed. And I have a few charts I thought might be helpful to show just because we really haven't gone very far, very fast. It seems impactful because Nvidia, sold back down to almost 100, bounced back up at the end of the day with the whole market. But let me just show you a few things real quick, okay? Because we do this every week and we have basically been talking about how we don't expect the market to do too much for the next month, right? And this was like 2 weeks after we had all this drama from April 2nd announcement of tariffs into the bond market crash on the 8th, and then the stick save by Trump and Bessent on the 9th. But we were here last week going, really, we're looking at sideways for the next few weeks as we get into the FOMC meeting. So just a little reference here. This is the April 2nd. This is E-mini, but this is liquidity. Liquidity has left the building, and until we can get back up, there is no bullish bent. So it's giving some time for the very large ranges in SPX to kind of calm down. So we really are just sitting right back up here. Look at this kind of 5,300, or in this regard for SPX, we're right back to that 52.64, which I keep talking about over and over again, right? So we're really just doing, what was it, more than 600 point week. This was another more than 600 point week. We're going to be here inside where a 5% move now is more like half of that. It used to be dramatic, and a 2.5% move is really a 5% move now. So we have to compress this down. Anyway, long story short, we really have just gone sideways. So I think we have this more in play for the most part, but gold has not been. We got to talk about gold because gold is the new VIX. So this is one thing that actually client George had posted some charts, and I wanted to show those to you because that is the one sector that is obviously hot fire flames. And let me show that one again because I think that really is. No, gold is the new VIX. Gold is the new VIX, but yes, but I hear what you're saying.
VIX, but it's like, and people look to sort of get into, they cannot look to the safety of the long bond anymore, and so I feel that it's kind of drawing that sort of safety hedge, that ballast that people look for. I mean, I don't know how long we've been going with the 60-40 portfolio getting kind of trounced, over the years. People still believe in that long bond, but really the divergence between gold and the long and TLT is quite incredible to behold.
It is, but let's show a chart on this because I know this is going to be a big question by some folks. Now, gold itself has a lot of reasons for moving higher. We have fiscal spending that's ballooning. It's not going down. We have geopolitical risk. We have trade wars, and it is the new VIX. And it really is not just gold, but also gold miners, for example. And gold miners have a double benefit going into earnings season because oil costs have fallen and 40% of their operating expense is in fact energy. But even Jeffrey had said a while back that metals could blue moon. In other words, miners in rare occasions actually outperform their underlying. And this is a situation where devaluation is absolutely stimulating this, advance in miners. And you can kind of see that with the dollar, which is just dumping, man. It is just still incredibly unsafe. So that's the money goes home scenario I've been talking about since February. This is the money stays home scenario also. They're not coming back into the US. Actually, Powell, when he presented today in Chicago, mentioned that the policies that are underway right now, even though they don't see intervening anytime soon because they haven't seen it in the labor market and because it would be, inflationary. But the point is, he did talk to a few things, which was, this is not a very good jurisdiction for investment, which is another way of also saying money, stay away. So even he's on that bent. But George is someone who put together and sent this, and I wanted to ask your opinion about this. Speaking of which, since you have some charts to show, this one is of gold volatility, and I know you love these volatility skew charts. I want you to comment on gold right now because it is the only sector that's really moving strongly higher. I won't go into all the reasons why, but I do want you to comment on where to from here since it is so wicked extended.
Yeah, that's an amazing flip and skew right there. We've actually seen that people push into the put side on TLT as well, but nowhere near the extreme kind of flip that we've seen here. I mean, the TLT makes sense. People are convinced that we're going to get those higher rates as opposed to lower rates, which really kind of throws a whole wrench in what Trump do. Gold is very interesting. I mean, this tends to be a little bit more normal in gold. So I would say that dramatic flip in the skew in gold is so pronounced that I feel that it's a little bit a sign of exhaustion, right? So it's a sign that some people are offside. They're the shorts are probably looking for ways to kind of minimize the further upside damage. So they're rushing into calls. So they're buying any calls they can get, which really pushes up that upside skew. So I would sort of guess that this is maybe a little bit of a sign of exhaustion. We're breaking all the lows we've seen over the last few years in terms of that short-term skew. So it feels a little bubbly at this point. point. But again, for a few weeks now, we've been kind of talking about, well, is there sort of a top in gold here? I put on a 1/2 put spread, a ratio put spread, and it's fine because I like it when things actually go the wrong way on those put spreads, because now you're long one put, you're short two puts as an example. And as we move away from the market, away from that, the sort of tent, you can actually, those short puts actually drop in value. So eventually you buy those back, even though, and the skew is going to help in that sense. Put skew is kind of receding a little bit, and you buy those puts back, and now you're sitting on very, very the long part of the strategy, which is very inexpensive because you funded the long puts with that short one. So the put ratios are kind of fun in a way because either gold goes down and then sits in this pocket where time sort of takes care of things and you sort of make a little P&L there, or it goes completely against you. We did one months ago on MSTR, which we talked about, which went completely against me. I ended up with 3 puts on MSTR that started to gain some good value. I didn't sell them, and then they sort of went to waste. But I love free puts. And that's one way you can do them. I'll set one up for folks a little bit later. But yeah, it feels a little bit like a sign of exhaustion a little bit. I don't know if you would agree, Samantha, because it just keeps going and going and going. It's a bit parabolic.
So this is the problem. Is that the more parabolic it becomes, the more fragile it represents the rest of the market becomes. So this is the new VIX, it's the new bond, it's the new, money flow. And that is actually a sign of much more instability. I've written about this a lot for clients, not gold per se. This has been a very strong trend long since last year. Gold broke out in March, silver in April, and it has just stayed incredibly buoyant. Silver is more industrial than, gold, the transactions, if you will, settlement in gold, hoarding in gold, seasonality in gold, macro malfeasance gold. I mean, it's just earnings, gold miners. There are so many reasons right now to be long gold and silver. The problem is it is a wicked, crowded trade. In fact, I was showing that to clients this morning. I probably don't have it right front and center, but the point is it's extremely, where Mag 7 used to be the leader of the crowded trades, it is now gold by a nautical mile. So you know what happens with crowd psychology. It is only when they get a reason to sell that gravity can take hold. Otherwise, also in prior instances where we've had parabolic runs in miners that have gone on for many, many months. So even the junior miners run by taxi drivers, it does not matter. They will still go hot and heavy. So this is the problem, is we get this speculative asset that becomes the de jour protection, and everyone's looking for protection. So even though earnings are going to come out and they're not going to be so bad because the bar has been lowered for 17 weeks, week after week after week, the earnings bar has been lowered. Banks just started. They actually beat. That's not surprising. The problem is guidance. And then United Airlines comes out and says, we're going to give a recession guidance and a non-recession guidance, right? So everyone's kind of like couching their bets. Gold is the one side of the coin where you know what you're going to get. So they're going for safety. And I would love to say there's a top here, and I don't ever recommend shorting all-time highs, which is what we've got. And I also don't recommend buying all-time lows, but things can become really explosive with gold. In the case of sell-off, I don't see any signs except it's extended. So
I agree. Yeah. And I know, what, I have a friend who was really playing it pretty heavily short, and he just gave up. He said, this isn't making sense. And I think that was kind of a good lesson in there. He sort of said, you get to the point where things don't make sense. And you know what the next stage of that is? It's you start doing stupid things, right? You go, this doesn't make sense. You get angry, you revenge trade. I've seen this many times. I've managed a bunch of traders. This is where it was very, very mature. He just said, you know what? I don't get it. I'm going to get out of this position. It just keeps going. Even when we had that nice rally back in markets, gold it barely paused, and then it just kept going up. So clearly that example of that friend is what's happening out there. People are throwing in the towel, and they're expressing that upside fear in buying calls, in buying protection. So you're right. There's no telling where it could stop. When it does pull back, it will be dramatic. It will probably just keep going. But for now, it seems to be.
I have a really hard time recommending shorting gold. And the reason is very clear, that we're in this deval phase, right? So we have a situation where the dollar keeps falling, and I've got 95 for the Dixie as a price target. And as long as that continues to work, yields higher, gold lower, this is all part of it. So I don't know if this would help kind of a macro framework, but I want to show you what I have for macro framework and why it's also not a short. And then I want to also say that I have the opposite problem where I have clients that are so, and I do mean so heavily long gold and or silver. They're playing what they see, but they're doing it with extremely large size. That's what makes me crazy. Is sleeping with that. But for example, this whole kind of write-up that I did, and I'm a little discombobulated because we were frustratingly outside of Zoom, unsure of what the heck was going on. So didn't realize the server error was in play. But here, let me just kind of show you this. This is from last week, and hopefully it'll make a little bit of sense, at least from a standpoint of where we're at. So I literally wrote gold is a new VIX, right? Last Thursday. And a lot of this focus, by the way, is dancing to default, which is another way of saying sovereign default in repayment of their debts. That's the focus of this. It's not like US can really default, we can print money, but we can default on repayment of debts. So the gist of it was Trump and Bessent have trailed, yada, yada, yada. Bond volatility is a really big risk, yada, yada, yada. Gold is up 19% as US dollar continues to crash lower. Risk of US yields continuing to rise with gold as dollar falls is a sure sign that they are losing control. So these are the macro reasons that underpin the gold advance. You've already heard me explain why Jeffrey is long the miners, but this is also something that is a trend trade that started last year. Moving to the exits, as funds move to the exits, gold becomes the new VIX. Okay, so then I go on. And the point I wanted to make was this. As fiscal credibility is eroding, this is something I wrote for clients because this is what I see, markets are starting to price in a higher cost that the US might default or debase its debt. Here are the things I'm tracking for signs of its progress. Okay, the 10-year Treasury yield rises even as risk assets sell off. And this is a dance. So just kind of keep in mind, we had a massive move higher last week, which is what caused Trump and Bessent to step in on April 9th and imply that they were going to pull back tariffs on Apple and chips. But in reality, they just said, nah, we're just going to give them 1 to 2 months. Anyway, the point is, we absolutely had a spike higher in yields, which was very, very damaging to U.S. credit, sovereign bond holders, equity holders, the whole thing. So anyway, moving on. Credit spreads have already widened, but this is definitely something that will continue. Term premium rises strongly. Bear steepening of the yield curve threatens, which by the way, whoosh, the 10 and 20, the 10-year, 2-year yield curve is up. It hit like 66 basis points, but it's hovering in the 50 range. That's really strong. Fed talk of cutting, they have not yet, and Powell confirmed that, although you can always get them to bend the knee one way or the other in time. But even if they do talk of cutting, long end yields don't fall, or potentially they even rise. We get some auction tails, which hasn't happened yet. These are big picture. Okay, so we're not just talking right now, but I'm getting to the gold part. Inflation break-evens rise with yields. That's happening. The dollar falls with yields rising. That's happening. And gold and yields rise together in a nutshell. So this is a massive, massive macro trade. And it's not just, central banks hoarding, China in particular, and all the other reasons. There's a really, really big reason why gold is spiking higher and why yields can move higher as well. So anyway, that's a write-up that kind of hopefully explains a little bit of why I don't recommend gold short. Absolutely not. Can I see profit taking? Yes, but I don't want to short gold.
Yeah, and that's, I think you can kind of sense behind the scenes. We saw one of the biggest sort of rate jumps in volatility that we've seen in a long time last week. And so I think, part and parcel of all the things that you're saying, under the hood, we have some bad things happening, right? And I think that's what we need to be prepared for. And I think it's almost a straddle-ish kind of market where I think at any moment, we've had full evidence of this. Last week, we got a couple, over the last couple of weeks, we've gotten 2 examples of if Trump says the right thing, or even half the right thing, this market can rally like a scalded cat. I mean, it will run 5, 7, 8, 10%. The shorts will scramble. But the equally so, I think that these fundamentals and the underpinning of this market is very, very weak. It's very thin. And so we could just continue to go down. So it's a difficult market to trade because at any moment you can get caught short something and you're just going to get trampled.
And look at this. This is not just us talking about recession risk and, recession. We're talking every Wednesday. Recession risk at the beginning of the year. Recession risk odds rising. They went from 25 to 30 to 50 to 60%. BlackRock, the largest asset manager in the world, Announced today on a Jack Farley episode, economy is in recession now. Their clients are going to hear that. So
Yeah, that's right. And people are they're getting their statements and going, wait a minute. I mean, last August was nothing. By the time you got your statement, no problem, right? This is a real problem.
that's true. It
And I
was a
think
V
people,
shape.
yeah, that was a V shape. That was like a blink. You blinked and it was over. Now, and I think people don't get lulled into a sense that okay, the VIX coming from 55 to 30 means things are okay. I mean, we had an ATR, an average true range, that was double
Yeah.
higher than COVID. It was double what we saw in August and higher than COVID. I mean, we priced in kind of something breaking is really what happened around 4,800, and thank goodness we got that sort of bond put rally. But there's no question VIX 30 might be the new 20s because of everything going on. If we truly are in a difficult,
It will be a little bit of a dance, but for right now, we definitely have no Powell capitulation. So let's talk about Nvidia and Powell today, since they were the highlights. And since really we have been tight as it relates to the range Monday, Tuesday, right? We're kind of waiting for something totally wicked awesome to happen or fall apart. And BlackRock coming out and saying we're in recession now is going to make the airwaves and make even more dangerous sinking sand. But Powell had a chance to come out and say, yep, you know what, we're thinking about it, but he didn't. So there is a duty. I know he's trying to fight for independence. I know he basically is worried now. Now he's worried about stagflation. He's worried about rising prices, not being so transitory, although he says it's one and done. Not so, not so. And slowing economic growth. So he admitted to both of those today. So he didn't help the market's sense of confidence. And then he doubled down and said, money will find that this is a difficult jurisdiction. He used the word jurisdiction, which is basically it's harder to be safe investing in the US. So he basically confirmed and pushed back against Trump. And that's going to create some friction. We already know that Trump is trying to kind of navigate ways to remove him. Basent has also confirmed and coordinated on that messaging. And Trump doesn't seem like he is the type of guy that's going to come back and say, I was just kidding. All tariffs are done. We've gotten what we want out of this. They have one thing that I thought was more planned and coordinated early on is now removed. So in other words, even whatever little confidence I had in this plan around tariffs as a way to negotiate to get their tax cuts and debt ceiling raised is now off the table because of how the bond market reacted. That was outsized. And now the credit market is pretty much frozen. Like they're not doing any deals. They're waiting to see what's going to happen. CLOs are frozen. This is not the loan market is frozen. So we really do have a lot of folks that are just waiting to see what happens next. And I think you can see it in the equity market. It's just not moving until we get an announcement like Nvidia, but that was already priced in. I did a write-up on that already. Continue. You were going to say something before I get onto the Nvidia front.
Yeah, with the restriction on Nvidia. To Trump as much as some of the others, but that whole area is just a little bit of a train wreck. But some of the things, as we've been saying, I think this has been a little bit of a gift. So I wanted to show people, just to give them a little something to think about. Is some of the things that I've been doing is I've been doing lots of sort of callers. I've been doing some put spreads as well, a little bit of VIX, but VIX has been it hasn't been tricky. I think some of those spreads are cheap. I think you can go in and buy like a, May 31, 32, 45, 50 kind of spread. And I think they're very, very cheap if you get the move out of VIX that you expect. But they are cheap. For a couple bucks, you can buy $15, $20 of upside. So I think those are interesting too. But I think another way that you can approach things is you could sort of say, well,
by the way, VIX stopped exactly on that 29.56. Do you remember we talked about that last week? So we talked about how that realized volatility typically goes down. And so VIX doesn't necessarily get crushed, but it definitely softens and comes down into VIX expiration, which was today. And this worked perfectly for March, right? We had the same exact MO. And then it helps the equities get stable. And literally that 29.56 that we talked about last Wednesday, it tagged yesterday, stopped on a dime, and turned up a little bit today. So
yeah, that was the spot. You're right. The double top there, and
Yep.
yeah, pretty amazing. I know some people say you can't can't chart the VIX. I disagree. Yeah, so that was an interesting spot there. And then the VVIX, of course, which had gone bananas, one of the biggest moves we've seen on the VVIX versus the VIX or versus the S&P downside that we've seen in many, many, many years. Really some extreme moves out there related to all the issues that we're talking about and stuff happening behind the scenes. But so I think the VIX is, I think it's still a very interesting place. The curve, if you look at the futures curve, we've got VIX above it. It's backwardated. It's in, it's not in a happy state. So structurally, I had a few members ask me about SVXY and SVIX, and I said, maybe, that was a few days ago. I said, maybe you can kind of squeeze a little bit out to the upside, but I said structurally, these things are not set up to do very well. And I'm talking about the short VIX products, right? I think you've kind of exhausted some of the benefit, which was the Vega benefit. That is the curve moving down, basically. You make money there. But in terms of the way you typically make money in an SVIX or an SVXY is when you have that beautiful contango and you've got structurally things are sort of made so that roll yield is essentially kind of rolling the long vol products to oblivion, which benefits SVIX. So we are not in that situation, right? So I'm not a huge fan of being long those products right now, except very, very tactically and in places here or there. But one of the things I've been talking about is, so I had this one portfolio and it's a bunch of leaps and it's a couple $100,000. And I said, one of the ways is you can kind of take a SPY. And what I like about the SPY is you really get kind of when you buy protection in the SPY or the QQQ, you really get that sort of very pinpointed level below which you are protected, right? And we talked about this last week, how VIX could do this and that, and it's sentiment and it's about mean reversion, and it's a different kind of animal that it is very related to the S&P clearly, but it doesn't always do the things that you necessarily expect them to. But if I own a 5100 put, I know exactly where my protection kicks in. It's at 5100. And so what you can do is you can take your portfolio and you can beta weight it. You can say, well, give me an idea of how my portfolio looks versus, let's say it's really tech weighted. Maybe you'd do this in QQQ. You'd say, well, that's more appropriate in Qs. What's my beta to the Qs? What's my beta to the S&P? And if it tells you, okay, you're a 0.9 beta, you might as well go all the way up. You're basically, because in a sell-off, everything kind of correlates to one. So you don't always get that perfect beta if you're sort of only looking at kind of normal times. In a sell-off, as we talked about earlier, you get everything kind of selling off fairly aggressively. But what you can do is you can beta weight and give yourself a good idea. Oh, okay, well, my portfolio moves at 90% of the S&P, or it moves at 110%. And with that, you can kind of model, well, what does my portfolio look like? So I looked at it and I said, well, it's this particular account is like, and I've used other hedges with this account. So I've been hedging with VIX and QQQ downside, but this time I said, for fun, why don't we just sort of beta weight it and see what it looks like? Well, it kind of looks like 400 SPY. And so then now that I know how this thing looks and how it's going to, there's no guarantees that it's going to move exactly. It's not perfectly fungible with the SPY, but I have an idea of how correlation may translate into a position in SPY. And so what I did is I went and I said, okay, I think this market's a little bit crazy up around 550, to be perfectly honest. And my approach with callers is sometimes I go with a 3-month caller that you can roll as you get very near that 3-month. But the problem with that is you start to lose some of your kind of reactivity as you get too close. So what I often like to do is a 6-month, 3-month, which means you get that 6-month position on, meaning you go out to September, October, whatever might be listed, and then you roll after 3 months. And so the benefit of that is if you keep rolling and giving yourself 3 to 6 months between expiry and roll, then you always have a decent amount of reactivity, right? If I have a put that's expiring next week and it's 500 points out of the money, it's not going to do anything if the market goes down 100 tomorrow, right? It's not going to be reactive at all. So if I have a little bit of a longer expiry, now I'm getting some reactivity out of most of the moves that I'm going to see. And that's what I want. I want Vega. I want the reactive. I want a position that's going to react to the market doing things, ignore it. So I went out to September and I said, well, I think we're kind of a little bit nuts up here and I'm perfectly happy, having upside problem at 575. So when I sold the 575 calls, and I can't remember what I got, the market was higher. I think I got around $14 or something for them. And I used that to buy a very wide downside put spread. So basically like a JPM caller kind of thing, right? You go in, you buy the 510, I think it was the 515 that I bought, and I sold a 420 or no, it was a 410, 515, 410. So I get this massive, massive put spread for, it was around a $4 debit. So I did pay a little. Sometimes people will do these and look for even money so they don't have to pay anything. But I wanted a little bit of extra sort of oomph to the downside. And that's pretty simple. And then so if the market does take off, this September is a long ways away. So there's no question about it. I mean, this market could be up. We get something positive out of this market, we could go up. So you have to be willing to manage this position, perhaps roll it up. But the assumption is that if the market goes to 575 or 600, your underlying portfolio is going to also do very well. So there's going to be that, give and take there. You're going to do much better in your portfolio than you're giving back in this position. But that's a nice way to kind of finance downside when option prices are very high, as they clearly are.
And honestly, we're going to have a lot of this. This is all headline risk driven. So we have to kind of zoom out and add time anyway. I mean, unless you are really camped out, there's a question here. How much of this was Nvidia? This $5.5 billion hit, which by the way, I contend was already priced in because this is not news. This exact requirement for licensing was in fact under Biden, and it was going into effect on May 15th. And I wrote about this actually last night for clients to remind them that, hey, this is why the market was so excited on April 9th when Trump came out and said, we're going to delay these tariffs on Apple and Nvidia, basically. But the other tariffs are going to go forward, yada, yada. So the point was, then he came out yesterday and said, no, actually at midnight at 12:01 a.m. Nope, by the way, these are going to go forward because they were already in play for May 15th. He's kind of like taking credit for it. But the interesting thing is also, as I wrote up, let me just show this real quick. It just makes me crazy. So this is something else where this whole noise, I'm going to call it noise, because it's very dangerous as a signal. This is something I wrote for clients, and I'm basically just grabbing a part of this, okay? The tariffs that are hitting for May 15th were basically removed on April 9th. That was the Trump tweet intervention. I would buy the market if I were you kind of thing. Okay, well, all of this is about Nvidia doing end runs, against, by way of Singapore and China. Otherwise, their sales would be flat. Again, client George is all over this. Now, enter Malaysia. I have a colleague on Twitter. We're called the Twitter randos, if anyone knows. They are Nvidia going backdoor, and look at the astonishing sales that are going by way of Malaysia. And is it a surprise today that Malaysia and China head honchos are, arm in arm going, we're gonna be trading buddies? No, it's not a surprise, because Trump is also forcing countries to choose allegiances, alliances, trading buddies. And this is not a surprise. Any of this is not a surprise. So anyway, the point is, those who were, of course, looking for any excuse to sell, we've got a reason, a headline risk, which could, by the way, just turn around next week. You never know. That's the problem, right? We're playing in this wide swath of volatility on individual issues against big tech concentration risk, which is what keeps the market up. We're not going to get saved by small caps. We're not going to be saved by bonds. They're absolutely flat on the year, and the market is down big for the year. So we're really looking for any place to hold out. And right now, other than gold, which is extended, money is just kind of, slowly being pulled out of markets, period. And that's the problem. There really isn't a lot of benefit until we get some more clarity.
Well, this is it. And so you continue to have this west going east kind of thing. And where have I got a little chart here, which is no here. So you've got these massive, look at this. This is amazing. When you look at the inflows, foreign inflows into the US market. I mean, what an absolute push. I mean, whenever you see something like this, you should be careful, right? Every time we see parabolic moves, I remember volatility in 2018. We saw retail do this too at the end of 2025. Massive pushes in. We were showing on our show, optimism. Optimism had gone parabolic. Literally, you mentioned that it was just, one survey, but it was a survey that showed just absolute parabolic exuberance about stocks. And I guess that's a sign when you see something like that, that people have overdone it. But look, the money's just leaving. It is just flying out of U.S. assets. Look at this fund allocation, global equities funds, of course, into Europe and China and out of USA. So we need to see some of that stop as well. So it feels like every time we get a little bounce, as we did recently, it feels like the sellers kind of take a pause and then they go, okay, let's get back to work and start continuing the pivot.
Well, this is also
pivot here.
part of the game plan, right? So this is, anyway, part of the theme that I have is that the falling dollar is what the administration wants, or I should say, not an overvalued dollar, and falling demand for dollars helps this dollar obviously lower, and it's supposed to help US exporters eventually. But in the meantime, we have a disruption, which is obviously trade wars are going to hit businesses and consumers, and so much so that BlackRock is out saying we're already in a recession. To answer your question, the Q&A, by the way, is today part of the VIX expiration? I don't think so. Usually in a VIX expiration, we expect, kind of some stabilization in the market. I think it really was the Nvidia headline pushing tech and semis. And then Powell came out and was not dovish. And that really is sentiment tell that the market doesn't have a backstop. There are really only two reasons the market would rally very aggressively. One is Powell capitulation, I call it. That's my tagline. And I was just kidding, which is a quote that I applied to Trump with this trade war / tariffs. And in lieu of those two things happening, we need liquidity. And liquidity right now is not coming in unless we get a lot of tax receipts into the government in the form of Fed liquidity. The dollar has fallen. That's a collateral trade that is losing its oomph, right? And the same thing with US Treasuries, or because bonds are down, that's also used as collateral that weakens liquidity. So we don't have liquidity coming into the market. So if we don't have liquidity, we don't have a headline of macro around Trump or Powell, the market's going to continue to flounder looking for a direction. Long story short.
Yeah, I think so. I think we could revisit, maybe that 4,900, 4,950. I'm not sure if I would get as bearish as you, sort of looking beyond that. But I mean, valuation wise, if we get down to 250, 260 in earnings, I hate to do the math, but that puts us down well into the 4,000s in terms of like a reasonable valuation. So investors don't really want to think about that too much. So I think it's just going to, again, it's kind of like you were saying earlier, they've kind of got one report for if things go okay and one report for if things go the other way. So nobody really knows which way things are going to go. So it kind of all depends on, is it going to be, I'm just kidding, or is it going to just continue to remain a difficult situation, which is going to weigh on the economy? And so my sort of silver linings idea that I think the economy was generally in okay shape, people doing okay, feeling wealthy, a lot of cash on the side, a lot of cash sitting around. I think people are okay. And I think there's an element of paralysis, which I talked about last week, which I think starts to overstay its welcome at some point, right? There's a paralysis in wanting to do things, in canceling vacations, in companies saying, well, we're going to hold off on things. That's a paralysis that can be overcome if you get the right news. But the longer this goes on for, the more the paralysis becomes an embedded problem. And so, that's the reality of where we are. Oh, I was just going to show, this is the extreme skew. Look at the Russell. My goodness, if you like the upside in Russell, that's getting super, super cheap versus this parabolic put skew here. But unfortunately, the option players seem to be right. And there's sheer panic has set into the Russell, I think, which the only thing that could help us is Tom Lee. And he's been quiet lately.
Not. Step away from the cookie jars. So I mentioned this to clients. I don't know if I mentioned this last week or not, but really, really, I say this every single week. So you really know my view. This is not a Tom Lee market. So when the market is rising 80% of the time, you have consensus bulls that are always going to say the same thing. Buy the dip, buy the dip, buy the dip. When the market is in correction territory, as I saw coming into the year, you want someone who can manage tail risk. I'm your girl. So this is not a market of buy the dip. It is short the rip. Anyway, that's established. The small cap 600, which is the best of the Russell 2000. So the Russell 2000 has 23% of components of constituents that are unprofitable and really, really not good. But they're in there. They're kept in there from this whole money supply and COVID and stimulus and low interest rates, blah, blah, blah. But they're going to blow up is more likely the case. So they take the best and they put it into another index called the S&P 600. And that is down to 2018 highs. So we've wiped out all those gains I'm literally talking 2018. Where is the benefit of going long? Maybe a bounce from 2018. That's the best you're going to get. But I don't see the benefit of that, especially as we keep talking about earnings getting ratcheted lower. Now, there's a comment in chat that says, do you still think that earnings are going to be disappointing? No, I never said that. I actually said Q1 would be fine. And the fact that they are re-rating every single week and lowering the bar. So the chances are really strong that they're going to beat. That's the game. That's the game.
And the pull forward too, right, Samantha? The pull forward on demand. I mean, I bought an iPhone for my wife. I felt a sense of urgency. I said, I got to get this iPhone before, like, I think there's a lot of that going on.
There is a huge amount of that going on, but the retail sales were very clear this morning. They delighted. It was much higher. Now, this is important. It was like 1.3%, which was greater than the 0.3% estimated. All of that gain was car sales. So folks were so freaked out about the tariffs on cars that pulled forward demand. They had their best quarter ever. So this is exactly what you're saying, right? They're pulling forward demand. And then, by the way, Q2 might be a little bit okay too, because he delayed tariffs. But Q3, oh my goodness, that's going to be the tell. So that's my concern, is the second half of this year. But BlackRock is already out saying we're in a recession. So I don't know. I know I haven't listened to the podcast yet, but honestly,
I think that complicates timing for investors, Samantha, because I think there was this notion that, okay, the first half of the year is a throwaway, and then we start to look towards regulatory sort of tailwinds and tax cuts and all the stuff that we were promised in that sort of back end part of. But I think I'm starting to, a couple of analysts or a couple of figures who said, you know what, we're going to just throw all of 2025 in the garbage right now and just start to look forward to 2026, because I think you might be right that these things start to get delayed even more, and the second half isn't going to be too pretty either. So
there's a question in Q&A that is related to treasuries, and then there's another question about crypto. I'm going to answer the crypto one quicker because I've talked with Jeffrey about this, and I know you like to trade MSTR, and if we get some bounce, of course they're going to move. They're NASDAQ proxies, all of them. But as the dollar falls, so too will Bitcoin. So this whole ecosystem is at risk, in my humble opinion, with falling dollar and rising yields. Now, we haven't gotten the rising yield part yet, really. We're still in this kind of chop zone, 4.3, 4.5. That's really not a danger yet. We get back above 4.5% in the 10-year, which is what happened on Tuesday night before the intervention. Then we're going to be in a whole different soup. But for right now, this is really stabilized, and we're still selling or chopping around violently. But with the dollar falling, that is definitely not bullish Bitcoin. I do know that there is a very popular chart that's out there that is related to, and I'm going to say this because it's not my wheelhouse, but I'm going to show it anyway. Hold on one second, because I have lots of smarter Bitcoin traders than me. But for example, this is the going concern, right? That global money supply offset by blah, blah, blah is a nice fractal with Bitcoin, and it's coming into the turn. You have another one, which is Raoul Powell, and their fractal as well, which is basically the exact same chart, but they do a 12-week lead time. So if then, this is really what they are expecting. I look at liquidity very differently. I don't look at just global money supply. That's not my measurement for strength, but I understand how it might be a very strong fractal for Bitcoin. And these are not my charts. I've already showed you that. If it's going to happen, it better happen right now. So if we're going to turn and this fractal of a chart is going to work, then guess what? It's also very bullish for NASDAQ, because NASDAQ and Bitcoin is a proxy of NASDAQ. And it's also what Jeffrey calls an inflation absorber. He's not a fan, but the point is, it is one way to resist, I should say, it's systematic. So instead of bidding up lots of commodities, they bid up Bitcoin. That is kind of the inflation proxy. Anyway, long story short, we'll see if that comes true. But on the flip side of that, with a falling dollar, it is very, very hard to be bullish Bitcoin big picture. So
T sort of mentioning, but Bitcoin's a hedge, it's digital gold. I think, yeah, that irony hasn't been lost on me. I think it's kind of interesting that we've been talking about how this sort of move away from digital, from things in the ether to touch and feel things on the ground. And sure enough, millennia old, record success from gold has taken over as the hedge, as Bitcoin has kind of not been crushed. I think it's done relatively okay. Well, it did get into the 70s though, but it has languished. So it is kind of interesting how things have played out as they sort of should, in a way, real gold as opposed to the digital.
Yes, it definitely
as you
a
say.
Value. Yep. Mike went in and out a little bit. And then of course a question is also hanging out there, which is no one's talking about this. 40% Treasury debt is maturing in 2025-26, a direct result of Yellen shifting issuance to shorter duration T-bills. This is very true. If you've been around me at all for any amount of time, T, I refer to November 1st as the Fed pause and Yellen Yahtzee. And that is where after issuing in June, longer duration, and then the market pulled back in July, August, September, yes, October, before she did this November 1st issuance of short duration in literally on November 1st. And we also had a Fitch downgrade when she was doing the longer duration. Anyway, long story short, the market stopped going down. You know this. You can look at a chart and you can see the advance was quite strong from that November 1st Fed pause and Yellen Yahtzee. But Cent is not changing anything until he can get the debt ceiling lifted. So he's got until about August, run out of money about maybe June, depending on receipts. So we are talking about it, but right now he can't do anything about it. So we can't do anything about it. So he's going to have to continue this quarterly funding on short duration until he gets the debt ceiling raised. Not he, but until, I should say, they get their act together and they raise that. But it also raises the deficit by 50% over the next 10 years. It is not something there's no austerity in that plan whatsoever. It continues all the spending bills from Biden and then some. So it's going to be an issue. There's no question about it. But for right now, that's not the liquidity concern that I'm talking about. That makes any sense? And then you say, do you think Trump's tariff threats are a form of leverage to negotiate more direct bids from foreign investors? Oh yeah, it's a pay to play. Hans, you were just talking about Meta, right? Zuckerberg, there's an article in Wall Street Journal that says he had like a $3 billion fine by the FTC. Now he's paid $45 million and that FTC charge has gone away. Jensen had $1 million dinner at Mar-a-Lago and then next day, all of us, exactly, right? So yeah, no, this is a paid to play. So yes, I think Yellen has done this brilliantly, by the way, over the years, getting Japan to keep buying. It's called bond stuffing. And Yellen did this with foreign central banks. I'm sure is doing this as part of the tariff negotiations. I totally think so. It's absolutely, they've got to finance the deficit, this ever-growing deficit. And who's going to finance it? But big pensions, central banks around the world, especially those that want to do trade with the US. It is a pay-to-play regime. There's no other way to look at this. How successful they are in doing that is another question. But yes, I agree with you. In a nutshell, it's not that we're not talking about the issuance, but right now it just wasn't front and center because he can't do anything about that percent. And then of course, pay to play, we're not going to be able to see these deals. We got some tick data today, but I didn't see that. But basically, we don't have a lot of transparency into detail right now. I'm trying to think, is there anything else? Oh, it's all quiet. We'll find out about it later. Yes, there's a lot of context in that BlackRock quote. It's a full podcast. Jack Farley, you can find it on YouTube. And okay, that's it. I answered those questions. But Bitcoin's a hedge. Okay, I don't know if we covered everything, but at least you showed up. Thank you so much for this, because we did get our power hour in, although started late. Hans, are there any other trades you want to go over? We talked about the ones that were most important, I think, which was patience on equities. We're going nowhere fast, violently. Definitely, gold's not a short, nor are miners, but they are parabolic. And all of the market that is basically long gold and miners will need a macro trigger to start profit taking. So be on the lookout for that. Otherwise, volatility is, it's expired, but it's in a new range. Instead of 10 or 20, it's now 30 to 40, as Hans keeps repeating. And it's still relatively affordable relative to the volatility that we have in the markets. So no sector rotation do I have news on. I noticed that oil volatility was falling, so that was a recommended long in some energy. But otherwise, we're looking for earnings just to get through it. And I really do not expect them to disappoint because the bar has been lowered, but we will be be looking for guidance. And any company that says we're in a sweet spot, they're going to be richly rewarded. And the companies that don't guide or give a negative guidance are going to be hit. ASML is already down on the mat. They also came out and said, we're worried. And they should be worried.
Yep.
Absolutely should be worried. China has already said to their own world populace, right? You may not buy any more outside manufactured chips. You must have a chip produced in China and buy it in China. You cannot buy Taiwan Semiconductor. Yep. You can buy ASML, CLAC, any of those. So they're really, they should be worried.
It's game on, right? It's game on.
Yeah.
The same thing with rare earths now and critical metals and things like that. It's game on across the board. So, you know, we're in the, I don't know what inning we're in, but we're in the middle of this game. And, you know, I'm looking forward to hearing from Netflix. I think that's interesting. I keep kind of, you know, adding some interesting positions to that. I think they're kind of in the right place. Costco, things like that. Costco, $1.50 hot dogs, and they just raised their dividend after the close. So I'm excited about things like that people need, that people aren't going to give up, you know, places to hide, not necessarily stocks that I think are going to go bananas because they're not that cheap, but places where the narrative is okay, right? As opposed to some of these injured areas that I think just continue to struggle, especially since they've been so heavily invested in, you know, how many people own Nvidia? My goodness, like the entire world.
A lot fewer now. I think they've lightened up quite a bit. Just a comment on Netflix, because we've had this back and forth on Netflix quite a while, and I'm still of the opinion that it is as good as it gets. And here's why. I'm on the other side of the trade, not yet, but after earnings. I think earnings is just going to be a premium seller's dream. It's not going to go anywhere near its expected move. Its expected move is like $85. And by the way, it's tomorrow after market close, which is, I think, 9.5% or something. Anyway, the point is, but the reason why I actually talked about this morning in my live trading room around Netflix, not to short it, because I think it's a premium seller's dream, and then we'll see what happens. But their international plans are part of this growth. So yes, they are recession proof as it relates to US based customers for sure. And they're also really going to be very popular if unemployment picks up for that kind of Netflix and chill, right? Binge watching, which is a downside. The reason why their price is so lofty is because of their international growth plans. Remember, that CEO doesn't want to stay a $400 billion company. He wants to be $1 trillion with his.
That's the weirdest thing I've ever heard. When have you ever heard a company say we want to be $1 trillion market cap? Like, it's just bizarre. That's a bizarre thing to say, but
that's it.
All right, whatever.
How are they going to do that? International expansion in the midst of a trade war when US is already getting boycotted, and we already have, I don't know how he's going to accomplish that, long story short. So I'd be a little cautious on that part of the growth narrative. That's all.
And the cyclicality of the ads, you know, the thing is their ad supported service is really doing the best, and the ad business may be under pressure. That may be part of what's going on with Meta as well. There's this cyclicality to that side of the business. But you're right. They have to keep doing things right. Having said that, I did sell calls on half my position today. So I sold some. I went out a little bit past this week. I sold the May 970s, and I think I got about $73 for them. So a really, really fat premium, which would be a pretty good move. But, you know, I think that's part of maybe, you know, I'm not a huge fan of anybody who's been watching our show or knows me. I'm not a massive fan of doing cover calls in general, unless I'm really given something special. And now we do have pretty nice pricing out there, right? Like I have no interest when the VIX is 12 in selling any cover calls, but now we're getting some juice for these things. So you know what? Take advantage of it. We may be in a difficult market for some time, and I think this is where you can kind of add a little value.
Super. Great place to end. Okay, I hope this added value, and I'm very grateful that you came back despite the delay, and hopefully no one else has any major interruptions with this outage, which might be rolling for a little while. All right, everyone, thank you so much. Join us again next Wednesday at the close for Macro to Micro Options Power Hour. Cheers, everyone. Bye.
Hey, everyone.
Thanks, Tom.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.